What's up, everyone? It's Scotty with Money Investing. We are going to be talking about a stock here that is absolutely getting destroyed pre-market, and that is going to be Chegg, CHGG, down a little bit over 46% pre-market, trading now under $10 a share. The market cap is most likely going to open around $1 billion per share, considering how much it's been sold off in the last 12 to 16 hours. So they reported their numbers after the markets closed yesterday. You can see that they're getting a ton of downgrades, and I'm going to break down exactly what happened with the Chegg here selling off. And of course, it's down now from highs of well over 30, 40, I think $50, or even as much as $90. It is down a little bit over, let's see, from 945, it's down over 91% in the last couple years here since February of 2021. So we have seen nothing but absolute destruction here for this company. So let's just quickly break that down. So as artificial intelligence technology continues to evolve at a rapid pace, we are embracing it aggressively and prioritizing our investments to meet this opportunity, said Dan Rosenzweig, CEO and president of Chegg. Now, AI is what's actually crushing the business right now, unfortunately, for Chegg. Now, numbers were quite decent. I wouldn't necessarily call them as bad or terrible numbers. They were decent. $187 million of total net revenues, a decrease of 7% year over year. Subscription-based revenue was declined 3% year over year to $168.4 million, which was, again, 90% of total revenue compared to 86% of the revenue in first quarter 22. Net income was dramatically down, $2.2 million, and non-GAAP net income, which was up to $38.1 million, and adjusted EBITDA $57.6 million and 5.1 million subscription subscribers, a decrease of 5% year over year. So they actually lost subscribers on a year-over-year basis. So again, these are right here are the numbers, and more specifically in their business trends update presentation, they mentioned in the first part of the year we were meeting expectations on new signups, and we saw no noticeable impact from ChatGPT on our new account growth. Since March, we saw a significant spike in student interest in ChatGPT, which we believe is having an impact on new customer growth rate. So there we go. They pretty much mentioned this in their report that ChatGPT in the first part of the year, they weren't having any issues. But then, of course, since March, they've had a huge spike in that interest, and now they're starting to slow down on their new customer growth. And similar to previous technology platform shifts, such as the internet and mobile, we believe AI is just as transformational, and we believe we've been aggressively shifting resources and focus towards fully embracing AI, as demonstrated by the Chegg Mate beta beginning in May. So earlier this month, pretty much yesterday, I believe, they started this new Chegg beta, that's a new Chegg Mate beta that's going to allow students to do a lot more things. We believe Chegg is in the best position to take advantage of the advancements in AI to the benefit of the student, making Chegg Mate a powerful and unique learning tool offered exclusively by Chegg. And as we plan to make important investments in AI, we are also evaluating areas to reduce existing expenses and CapEx to maintain industry-leading margins and cash flow as well. So this right here are some of the 2023 priorities that they've set forth. Leverage the power of AI is number one. So this is a prime example of, either embrace it or be crushed by it, right? This is artificial intelligence in literal action, where you are seeing people use AI, right? So, why go after Chegg and get answers to your questions or essays or problems or whatever, where you can actually use AI to use the same thing for, perhaps a much lower cost, or even in most cases, ChatGPT and some of the other tools are even free out there. So Chegg really needs to get creative here. They really need to get creative in a way that they can successfully build and roll out an AI conversational learning companion that will empower students to learn in real time more effectively with greater accuracy than ever before. And of course, their other priorities are profitable growth, international exposure, languages, adding different languages, and of course, adding different skills as well. So long-term strategic focus is still on growing subscribers, growing profitably, extending the lifetime value of each customer, overwhelming value, driving outcomes, and helping holistically as well. So this right here is the growth in the subscription subscribers for Chegg. You can see that they've grown from 3.1 million to now over 8.1 million subscribers on their platform for subscriptions. And this right here is going to be the overall revenue. What you will notice is that quarter over quarter or year over year, we have seen that growth rate really slow down. They're not on that exponential path anymore. They're now starting to grow a little bit more linear growth. And again, 2021 to 2022 revenues, even though we have seen decent growth here, 672 divided by 617. That's a growth rate of about 9%, which they didn't highlight. They obviously highlighted the 33% growth since 2018 and 28% growth since 2018 for subscribers, because 8.1 divided by 7.8 is going to be a growth rate of about 4%. So makes sense. This right here is going to be their balance sheet. So as of March 31st, 2023, they were sitting on about $281 million of cash, which is dramatically lower than same time last year of 473. Short-term investments are also lower. So at one point, they were sitting on almost $1 billion of cash and marketable securities, and now they're sitting on just under $600 million. But their long-term debt, if you take a look over here, their other long-term liabilities and then convertible senior notes are sitting at over $1.1 billion. So that is really unchanged at the moment. So, you've got debt, which is dramatically higher at over $1.1 billion. You've got long-term investments sitting at about $613 million, and you've got cash and marketable securities at around $500 million. So more or less, it's equivalent, right? You've got cash and marketable securities that have gone down on a more current basis, but they have moved over to long-term investments that they may have made that are maturing in over 1 year. So it's really not an issue. The balance sheet is still pretty good. You've got current assets at $637 million versus current liabilities of only $140 million. So very strong current ratio, and total assets also do exceed total liabilities by more than 2. And not to mention that they've also got cash, marketable securities, and long-term investments that's more or almost equivalent to their long-term debt. So that again is not that big of a deal. But the main problem is in the growth of the business itself, right? It can be self-sustaining for some time, meaning that balance sheet's good. I mean, there are plenty of subscribers right now. But the real question is the future. The future is what we really need to determine for Chegg. Can they survive this AI revolution? Can they incorporate AI in a way that keeps them relevant and continues to help them establish their brand and continue to grow subscribers? That's the real question. Kind of brings me back to Zoom, right? Zoom is a company that is very similar to Chegg. What is their relevance in the future, right? They also have a great balance sheet, right? They've got plenty of cash, very little debt. They can survive for as long as they need to with the balance sheet that they have. But the real question is, can they continue to grow revenues? Can they continue to grow earnings? Can they continue to grow subscribers? Those are some of the main questions for future growth here. And you can see that in the first quarter 23, revenues declining, gross profit declining, operating income going to an operating loss. But again, this is on a GAAP basis. So I'm assuming that there were some intangible amortizations, which resulted in operating losses, and of course, net income also declining on a year-over-year basis, with diluted EPS down 50%. Share count is also lower, which is a little bit of a plus sign for the company. Now, if you compare this to, again, what we have really seen for Chegg is that a very consistent and nice growth in revenues from 255 to over $767 million in revenue. Gross profit, take a look at that. A very, very nice, consistent growth, right? If you come down to operating income, it has recently turned the corner towards profitability. Of course, last year, because of some amortization, it was a little bit lower. And again, net income and EBITDA really have been on a consistent growth to the upside. Again, more recently, though, it has been a little bit lower. $266 million was last year, and share count has also gone up on a more consistent basis from 21 million to over 149 million. But more recently, in the last couple of years, they've only gone from 125 to 150. So I'll let them, slide that a little bit here. So if you take a look at the valuation for the company, it was, well, before today's pre-market action, it was trading at 15 times earnings. And now I think the expectation is going to be closer to 7 to 8 times earnings, considering how much it's already dropped pre-market. And enterprise value to EBITDA 21. We've got price to sales now trading at 2.82. It's going to be probably trading at 1 now, and price to cash flow at 8 to 7. It's probably going to get halved as well, considering the pre-market action at the moment. Now, in terms of margins, again, we've got some pretty good margins, 74% gross margins. You got 34% net income margins. But again, can these margins be sustainable over the long term is the real question. And return on capital is pretty poor. Return on assets is decent, and return on equity is actually pretty good at close to 24%. So if you come over to earnings estimates, right? So what are the analysts actually pricing in? We've got $1.18 for this year, which is going to be a 9% decline in EPS. So when we plug in those numbers, $1.18 to as much as $1.35 by 2025, that's only a growth rate of 7%. 7%, right? That's it. That's a pretty small growth rate. Now, even if I go with 5% growth rate here for Chegg, right? Even if they can, let's say, somehow manage to grow net income by only 5%, over the next 5 years, from 266 million all the way up to $339 million by 2027. That's going to be that growth rate, 5%. And we apply a 10 PE multiple, right? That's going to be 10 times earnings. We go with a discount rate of 12%, margin of safety, maybe let's say a little bit higher of 20%, and share dilution of let's say 5% because they have been consistently diluting shares. We've come down to a fair value of $8.05. Guess where the price is trading pre-market? It's trading at $9.59. We're actually not that far off to make some very, very conservative assumptions here, even if Chegg only grows by 5% with a 10 times P multiple and a discount rate of 12% and margin of safety of 20%, 5% share dilution priced in, we get a fair value of close to $8. This right here is going to be that sensitivity grade that you can see and kind of do some of your own analysis. And right now you'll notice that $9 is where we are, and you can again take a look. And of course, if they end up declining in revenue over the next several years, let's say that they decline by 1% net income, and they're trading at an even lower P multiple, let's say of 6 times, then you come down $3.60 would be that fair value for Chegg. So I'll let you be the judge. You decide, what is appropriate for Chegg. For me personally, I think they can do it. I think if they can incorporate AI in some way, they're going to be able to retain most of these subscribers. I don't think they're going to see this mass exodus, people leaving Chegg and going after ChatGPT. But I think if they can execute this artificial intelligence and create this companion Cheggmate, which is going to help them, I think it's possible that they retain their value, their relevance over their subscribers. So it does seem a little bit overdone, in my opinion, down over 46%. It's going to actually come down to more of a value territory. I'm going to do some more analysis on this company from a more, tangible net, asset value standpoint, from its liquidation standpoint, and what is going to be that actual price per share, where it can absolutely, be liquidated at, right? So if you were to kind of completely write off Chegg as a bankrupt company and it sold off all its assets, what would be the price of that stock? Because we can kind of get a good assumption of what that value is going to be for Chegg, where it's just really going to be a no-brainer at that point. So I'll do some additional analysis, but this right here absolutely getting crushed pre-market. I mean, down 45% from its all-time highs of $118, now down over 92%. But for me personally, it does seem a little bit more on the overdone side. It wasn't like the results were terrible, right? It wasn't like it was like insanely bad. It was only down 7% revenue year over year. Net income was slightly lower. EPS was also down because of those gap earnings. Balance sheet's pretty solid, and they are doing the right things to adapt, to evolve with AI. But yeah, man, market's brutal. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video from a technical standpoint, there's absolutely not going to be any trades. There may be a dead cat bounce intraday, but be careful. There's going to be a lot of volatility. There's going to be a lot of action on this company. So definitely be very, very careful in the way that you analyze and, of course, trade this stock. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.